we are not advisory. Over the course of our presentation, we will be describing for you what we view as the big challenge, the labor market, consumption, investment, supply side factors, and finally, we will conclude with our overall economic outlook. Firstly, the big challenge. The objective of the Federal Reserve is to maintain stable price levels and maximize employment. At the moment, inflation is high and is elevated above our target level of 2%. In addition, consumers expect it to remain high.
Despite the recessionary concerns that so many commentators have raised in the past few months, inflationary issues continue to be our number one concern, and we will do whatever it takes to reach our 2% target goal.
Yes, headline inflation currently sits at 6.2%, remaining elevated due to volatile energy and food prices caused by dislocations. However, even our core measurement of inflation is largely above target, currently at 4.9%. To quote Chairman Powell, the longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
Exactly. We already see signs of high inflation expectations in the three indicators that we monitor. Our strategy is aimed at bringing down these expectations in order to reach our 2% target in the least painful way possible.
There are several macroeconomic trends that continue to push inflationary pressures upward. Global supply chain dislocations remain at an elevated state, which has increased uncertainty regarding future supply-side factors. Energy prices have seen a moderate decline, but the food index continues to add upward pressure on core PCE.
While focusing on inflation, we will continue to closely monitor economic activity. A slowdown in economic activity is already visible in the real GDP growth rates of the first 2 quarters of 2022. Average long-run GDP growth is predicted to be at 1.8% based on June projections, according to the Summary of Economic Projections.
Due to inflationary pressures, supply-side issues, and our actions to bring down inflation, we expect to see GDP growth below trend for the upcoming quarters, but to recover as inflation begins to curb.
Agreed. And in what follows, we will provide a more detailed economic outlook and further reasoning to back our policy stance.
Let's start by looking at the labor market. We recognize that we are in a unique position in history due to the effects of the COVID-19 pandemic. Due to thriving economic conditions in the post-pandemic era, the labor force participation rate has drastically increased due to an increase in demand for workers.
Although we may not be at pre-pandemic levels, we have rebounded tremendously compared to where we were in April of 2020.
On a more disaggregated level, the pandemic has disproportionately affected women, as the lack of childcare has caused them to exit the workplace to stay home.
When the economy opened back up and businesses reopened, however, women returned to the workplace at a higher rate than men, as depicted on this graph.
That strength of recovery is visible in unemployment statistics too. Both the U3 and U6 are at historically low levels. However, there may be some reasons for concern, as we notice an increased gap between U3 and U6, as many people have transitioned from full-time to part-time employment in a post-pandemic era.
Accompanying historically low unemployment, the vacancy rate is at historically high levels. The US economy is in a very unusual position, as demonstrated by the beverage curve. Employers are currently facing the challenge of filling vacancies while few people are out of a job.
This imbalance between vacancies and the number of unemployed people is manifested in the pace of wage growth, which is higher than pre-pandemic levels. We expect this trend to soften as a way to continue to realign both vacancies and unemployment.
Overall, despite recessionary concerns, the labor market appears unusually strong. On the flip side, this strength fuels wage growth, which contributes to inflation. We expect labor force participation to continue to rise, easing this trade-off. However, we face some uncertainty over the magnitude of this trend.
Now we'll take a look at consumption. Consumption has remained relatively elevated in the last few months, recovering fast from the early stages of the COVID-19 pandemic. Strong consumer demand and consumption has further elevated upward price pressures and has been a catalyst for the recent inflationary spikes. Although we are starting to see signs of a plateau in consumer spending, consumption still remains high.
Yes, and that is correct. At the moment, this strength is concentrated mostly within the durable goods section.
Looking at consumer sentiment, it has begun to flatten after a long decline following the COVID-19 pandemic. While there has been an uptick in the last 2 months, currently, consumer sentiment is still at a historically low level.
Inflation and the fear of financial instability, as seen in the equity market's recent decline, has been a key driver in the reduction of overall household confidence. Looking further at households, the savings rate has stabilized below pre-pandemic levels at around 5%. This shows that households are still actively consuming and spending their savings.
That's correct. And retail sales have also stabilized at a relatively high level, rising 0.3% in August of 2022. Consumer inflation expectations may be quite high, as many consumers are purchasing goods now rather than at a later date. However, we do notice a smoothing of retail sales as consumers battle a higher inflation. We look to take both forceful and rapid steps to moderate demand so that it comes into better alignment with supply, just as Powell states.
Overall, we believe that consumer behavior illustrated by this graph is consistent with the idea that inflation expectations remain high. Their spending is strong, especially on durable goods, while savings are low, in spite of low consumer confidence. This behavior exerts upward pressure on inflation.
It's also important to note that the student loan forgiveness program that Congress is about to pass will reduce household debt and compound these factors.
We believe that our success in restraining inflation depends crucially on our ability to persuade consumers that inflation will come down, and we are determined to bring it down.
Now entering the finance and investment section. Although housing prices remain at elevated levels in comparison to pre-pandemic levels, they have cooled marginally for 2 consecutive months since July of 2022. This comes in the wake of rising 30-year mortgage rates, currently standing at a 30-year high, significantly above the 10-year average.
That's correct. This rise in mortgage rates, correlating with rate hikes over the course of 2022, has resulted in 6 consecutive months of decline in Fannie Mae's Home Purchasing Sentiment Index. Even with slight indications of housing prices cooling, affordability is still a major constraint for potential homebuyers. Rent prices remain elevated above pre-pandemic levels, as well as in the year-over-year percent price change, which has shown signs of potential plateau with a 4.9% decrease from February to August. Regardless, consumer sentiment shows consumers expect a slight increase in rent prices over the next 12 months.
That's a good point. Although both existing and new home sales have slowed in the latest surveys, total home sales are down 17% since the beginning of the year. Freddie Mac expects housing demand to moderate and forecasts home sales to slow to 6 million by the end of 2022 and 5.4 million in 2023.
Yes, and furthermore, new housing permits decreased consecutively through July and August, as shown in graph 2 here. This decrease in permits comes in line with a 9-month consecutive drop in the Wells Fargo NAHB Housing Market Index. This suggests that residential construction is coming under pressure as higher borrowing costs and elevated prices compound affordability challenges.
This will certainly be something to watch going forward. Consumer sentiment in the housing market and rising mortgage rates have the potential to cool extended inflation of shelter prices, as housing accounts for both a significant portion of CPI and core PCE. So far, we believe that the recent rate hikes are beginning to show signs of success in preventing excessive price increases.
Other signs of the effect of the Federal Reserve's policies are visible in the stock market. As of October 2nd, all 3 major stock indices listed in the graph here have fallen at least 20% from the beginning of 2022. This is, however, a steady decline, and we do not observe large disruptions. Hence, we are not currently worried about financial instability, although we will continue to monitor the situation.
Finally, are we headed towards a recession? A leading indicator of recessions that has proven to be reliable is the yield curve spread between the 2 and the 10-year Treasury securities, or the 3-month to 10-year.
Yes, and although the most reliable indicator of recession is a 3-month to 10-year spread, according to the San Francisco Federal Reserve, what we've observed historically is an initial inversion of the 2-year to 10-year spread and a later inversion of the 3-month to 10-year before the final recessionary period shows. As shown by the graph here, the 2 minus 10-year has inverted already, and the 3-month minus 10-year dances close to that inversion point.
But as of now, the yield curve is showing warning signs of a recession, but the picture is not clear just yet. Our big takeaway is that the situation needs to be monitored, and we should be aware of the possibility that a recession may come.
Finally, it is important to monitor the various supply side factors that have caused much trouble during and after the pandemic. Reduced availability of materials, an increase in their prices, and supply chain bottlenecks are all issues that contribute to rising inflation while reducing economic activity.
Our current outlook is more optimistic. Over the past 6 to 12 months, demand for goods and materials internationally seems to have peaked. Supply has risen, and prices have been trending downward since the spring. This drop in demand can be attributed to the recessionary risks internationally, while increased supply stems from the resolution of issues caused by the pandemic.
China has also experienced a multitude of issues over this time period, with both their manufacturing and real estate sectors taking huge hits due to demand decreases, both climate and energy concerns, as well as their strict COVID-19 lockdown policies.
An important input for the US economy is oil. There's been a visible decline in oil prices on the American front since May of 2022. Crude oil prices have seen decreases not only because of dropping demand, but due to a rise of supply. The United States government released over 180 billion barrels of oil from the Strategic Petroleum Reserve, with a declared intention to hold off on replenishing the reserves until the end of the fiscal year 2023. While the one exception with commodities is natural gas internationally, however, US domestic oil prices have followed similar commodity trends.
Yes, and in a time period of high uncertainty on the international front, we still expect these supply side movements to persist as the world continues to loosen COVID regulations, which alongside the likelihood of continued decrease in demand for commodities and goods should keep bottlenecks and threats of supply shocks in relation to the United States at bay.
Overall, the picture appears more optimistic than it was in the recent past. We expect these trends to continue as the post-pandemic situation normalizes. However, the current environment is plagued by a high degree of international uncertainty. The euro area seems to be on the verge of a recession, the future developments of the war in Ukraine are unclear, and the Chinese economy is facing a variety of challenges.
Due to the international developments, there have been implications on US trade with other countries. The USD has strengthened relative to other currencies due to the particularly aggressive rate hikes in the US and the challenging economic issues of the other countries.
The strengthening dollar will bring down exports as US goods look relatively more expensive in international markets. As the dollar strengthens, we could also expect imports to increase in the medium term as international goods look cheaper in domestic markets.
Finally, we would like to discuss our overall outlook and policy recommendations. Looking at the current economic conditions in the US, we believe that there are some reasons to be concerned. Inflation is high, and the stronger the efforts to bring it down, the higher the probability of below trend growth and an increase in unemployment. We believe that our success in filling our dual mandate crucially depends on our ability to bring inflation and, more importantly, inflation expectations down. We will do whatever it takes to restore inflation to our 2% target.
While taking an aggressive approach on inflation, we are not disregarding our second objective of keeping employment high. Although we anticipate some pain for households and businesses in the short run, a failure to address inflation now will mean even more pain for a longer period of time.
As both President Evans of the Chicago Fed said, as well as Jerome Powell, if inflation expectations do not come down, we risk entering an inflationary spiral.
Therefore, our top priority remains inflation. We will closely monitor the evolution of economic activity, but we will remain committed to bringing down inflation.
Well said. And although this trade-off appears ugly, we also have reasons to believe that the terms of these trade-offs will improve. There are two major tailwinds that are worthy of consideration. The first being the labor market is unusually strong, with high vacancy rates and an upward trend in labor force participation. If labor force participation keeps rising as we expect it to, the pressure will be to reduce inflation and increase economic activity. As vacancy rates are particularly high, we expect the potential slowdown in the economic activity to be easier on the labor market than history may suggest.
The second reason to be optimistic is that, as we have seen, and as recently pointed out by Williams, president of the New York Fed, other supply side concerns have shown clear positive trends that we expect to continue. Nevertheless, the international situation remains quite uncertain for many different reasons that we will continue to monitor.
Once again, it is our long-run goal to achieve inflationary levels of 2%. We have decided to raise the federal funds target rate another 75 basis points, raising rates to a range of 3.75 to 4%. Furthermore, we believe future rate hikes and selling off the balance sheet at a rate of $95 billion per month will continue to be necessary to put downward pressure on inflation. We will continually assess our policy recommendations by factoring in inflationary expectations, as well as the current economic climate and the effectiveness of our previous rate hikes.
We will be raising the federal fund rate by 50 basis points at our meeting on December 13th to 14th, pushing the target range to 4.25 to 4.5%. As we enter the new year, we expect in mid-2023 to have the federal fund rate be at 5.5% on the upper bound.
Yes, and we emphasize the necessity to hold rates high until we begin seeing that downward pressure on inflation. However, we firmly believe that bringing down inflation to 2% is the most important goal for the Fed. If we continue to let inflation run rampant, long-run labor market conditions would worsen compared to the effects we will see from policy rate hikes.
To achieve both sides of our dual mandate, we need to continue to fight inflationary pressures, regardless of short-term impacts on the labor market. As reiterated by Chairman Powell, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Thank you, and we look forward to fielding your questions.